Hi, welcome back. I'm Professor Gonzalez. The topic today is going to be the classified balance sheet account categories. We are going to be looking at the account categories for assets and liabilities. The account categories for assets, there are 4 of them. We have current assets, long-term investments, plant assets, and intangible assets. And in a minute, we're going to go through all of those, give examples and description. For the liability side, there are just 2. Current liabilities and long-term liabilities. For the current assets are assets that are expected to be converted to cash or used up within 1 year or the operating cycle, whichever is longer. Now, when I was in college, I never knew what that meant. What does operating cycle mean? So operating cycle, the best example is a winery. If you think of the wine in a winery, that's an inventory account, which is an asset. And even though the winery has to keep that asset distilling for longer than a year, it is still considered a current asset because their operating cycle is longer than a year. So examples of current assets are cash is already current because it's already cash. Accounts receivable. Accounts receivable are amounts that customers owe us. They're typically going to be collected and be converted to cash within 30 days. Prepaids. We don't typically prepay longer than a year. It can happen, but it's usually like a 3-month, 6 months, so it's less than a year. Supplies. Supplies are items that are used internally and we don't stock them typically for longer than a year. Inventory. Inventory are items that we purchase to resell to customers. And believe me, companies do not want to stock inventory for longer than a year. They want to sell it as fast as they can so they can get the cash in to pay for that inventory. Short-term investments. Short-term investments could be investments in stock, trading securities that they plan to sell if stock prices increase. So those were examples of current assets. Now we're going to look at long-term investments. So long-term investments are investments expected to be held longer than 1 year. These are assets. So land held for investment. If you have a piece of land and you're just holding it, planning on selling it when the prices go up on that land, the market value goes up, that would be considered an investment. Held to maturity debt investments. So if you purchased corporate bonds from a corporation and they don't mature for 10 years, they are considered a long-term investment. And equity method investments with significant influence. If the company buys corporate stock in another corporation, between 20 and 50% of the outstanding shares, that is considered an equity method investment, and it is categorized as a long-term investment on the classified balance sheet. The next category is plant assets, commonly referred to as property, plant, and equipment. Plant assets are tangible, so that means you can touch them. They're used to operate the company, so they're used to run the company. They have a life longer than 1 year, or again, the operating cycle. Most of the time we're looking at 1 year, but it's whichever is longer. So examples of plant assets are buildings, machinery, equipment, automobiles, furniture. So if you think about all these, you can touch them. Now there's a few things I want to distinguish. Computers is also a plant asset, as long as it's being used to operate the company. So if you think about a company that sells computers, the computers that they're selling are inventory. That's a current asset. But maybe the computers they have in the back office that they're using to run the company, to bill or anything like that, those would be considered a plant asset. The other thing I want you to understand about plant assets that you're not usually going to read in a textbook is they have to be relatively expensive. If it's think about a calculator, right? A calculator fits all this description. It's tangible. I could use it to calculate some stuff for my company, and they have a life longer than a year. But we would typically not record a calculator as a plant asset. We would expense it as an office supply expense. The last category of assets is intangible assets. Intangible assets have no physical substance. They provide a competitive advantage to the company. Examples are trademarks, patents, copyrights, goodwill, and franchise. So trademarks are the marks that you see on like Coca-Cola, Amazon, all those different companies. They have that competitive advantage. Those cannot be used by anybody without permission. Patents allow like drug companies, pharmaceutical companies, they research and develop a product and that they're allowed to use that product and have the sole right to make it for a certain period of time. Copyrights, that relates to written material and videotaped material so that people can't copy it. Because you can imagine if you were writing a book and somebody could just go copy it, then why would you ever write the book, right? Goodwill, that is related to when a company purchases another company and they purchase it for more than the equity of the company. Franchises are things like McDonald's. McDonald's is franchised, so if you purchased a McDonald's franchise, you have to pay a fee, and that's related to, that would go into intangible assets for that franchise. Okay, now we're going to look at liabilities. There are two categories for liabilities. The first one is current liabilities. So current liabilities are liabilities that we expect to pay within the year or the operating cycle, whichever is longer. So remember, when we're looking at these time periods, we're always looking at the end of the current year and the 12 months after. So if we're going to be paying it the 12 months after the end of this current year, then it is a current liability. Accounts payable, those are amounts that we owe to our vendors or suppliers, usually going to be payable in 30 days. Salaries payable, that relates to our employees having worked at the end of the period and we're going to pay them next period. So we are going to be paying them soon. Interest payable on loans or bonds, again, usually paying them in the next period. And unearned revenue is when we've received cash and we have not done anything to earn the revenue. So once we earn the revenue, usually people are not going to pay us earlier than 12 months. So once we earn the revenue in the next period, it is no longer a liability. So it is considered a current liability. And then short-term notes payable. There's a notes payable in accounting, remember, is a loan. If we have a short-term loan, like a 6-month loan, then it's considered a current liability. And then the last category, long-term liabilities. These are just the opposite of current. They expect to be paid or settled in more than 1 year. Examples are any loans longer than a year. So if you have a 5-year car loan, that would be long-term. Mortgage payable, if you have a building and you have a mortgage on it, it's a 30-year mortgage. That's a long-term liability. Bonds payable. Bonds are a liability. You have to pay the principal back on it. And it's usually very long term, 10, 20 years. And then pension obligations. Pensions are you're paying to your employees when they retire. Again, a very long-term liability. Thank you so much for watching. Appreciate it. Please click on the EdVantage logo to subscribe. See you next time.